There's a number buried in every single investment fund you own right now. It has a quiet technical name. It's called the expense ratio. And depending on that one small number, this expense ratio, it might cost you $100,000 over your entire investing lifetime. Or it might cost you almost nothing. Here's the truth that should make you pause. Most investors, including possibly you, have absolutely no idea what the difference is, but after today's video, you will know exactly what to look for and exactly what to do about it. Now, before we get into the numbers, and we are going to get into some very eye-opening numbers, I want you to understand something important. These fees are not accidents, they are by design. The investment industry is built on fees that are small enough to ignore, but large enough to matter enormously over time. These are fees that compound silently over decades. They do not send you an invoice. They do not ask your permission. They simply reduce your returns year after year without ever appearing on a single statement you receive. That is the real problem, and that is exactly what we are fixing today. Let me give you the single most important financial fact I'm going to share in this entire video. Ready? A 1% annual fee, just 1%, sounds completely harmless. It sounds like almost nothing. After all, it's just 1 penny per dollar. But over 30 years, the length of a typical investing career, that 1% fee destroys between 25 and 30% of your total portfolio value, not your gains. Your total portfolio value. That is a quarter of everything you work to build, gone, silently, legally. And here's what makes this particularly painful. You worked hard for that money, you made the smart decision to invest it, you did everything right, except for one thing, you did not check the fees, and the industry was counting on exactly that. But that changes right now, because once you know what to look for, once you have seen the real numbers, you cannot unsee them. And the action you take this week could be worth tens of thousands of dollars to your future self. Let us look at the data. Before we dive into the numbers, and I promise these numbers are going to surprise you, I also want to make sure you understand something crucial about how these fees work. Because it is not just about paying one fee once, it is about how those fees compound against you silently every single year for decades. Think of it this way. Every year the fee takes a cut, not just from your original investment, but from your gains as well. So the fee is eating your money, and it is also eating the money that your money would have made. That is a compounding effect working against you. It is powerful and it is avoidable. Here's the proof. All right, let us talk real numbers. And I want you to imagine this scenario very clearly. You have $10,000. You invest it today. The stock market returns 8% per year, which is roughly its historical average, and you leave it alone for 30 years. Simple. Now watch what happens depending on the fees you pay. 0% fees. After 30 years, your $10,000 becomes $100,627. That is the power of compound growth with no interference. Beautiful, right? Now, let us add a tiny fee. 0.05% fees. That is the expense ratio you pay in a Vanguard index fund, one of the world's most popular low-cost funds. After 30 years, your $10,000 becomes $99,214. The fee cost you $1,400, small, acceptable, almost nothing. 1% fees, that is a typical fee on an actively managed mutual fund, the kind millions of people own right now without question. After 30 years, your $10,000 becomes $74,435. You lost $26,000 to fees. 2% fees, this is what some financial advisors charge, and many investors pay this without ever realizing it. After 30 years on the same $10,000 investment, you end up with $55,208. You lost $45,000 to fees on a $10,000 investment. Now, let me put all four numbers side by side so this really hits home. The difference between a 0.05% index fund and a 2% managed fund on the exact same $10,000 investment in the exact same market is $44,006. $44,000. on just 10,000 invested. Think about how much you have actually invested or plan to invest over your lifetime. Now multiply that gap by 10, by 20, by 50. This is not a rounding error. This is life-changing money. A car, a year of college, a down payment on a home, silently taken from you in fees. But here is the good news, and there is very good news here. This is one of the easiest problems to fix in all of personal finance. You do not need to time the market. You do not need to pick the right stock. You just need to choose the right fund. And that starts with knowing the 3 types of fees you absolutely must understand. 3 fee types. Every investor must know all 3. Number 1, the expense ratio, the most important and most invisible of all. Number 2, transaction fees, what your broker charges you to buy and sell. And number 3, advisor fees, what you pay a human to manage your money. Let us take each one apart. Fee type number 1, the expense ratio. This is the annual fee charged by the fund itself, the mutual fund or the ETF that holds your money. And here's what makes it uniquely dangerous. It is deducted automatically, directly from the fund's returns. You never, and I want to be very clear about this, you never see it leave your account. There is no notification, no email, no charge on your bank statement. It simply reduces the growth of your investment silently. That is why millions of investors pay it for decades without ever noticing it exists. So here's your first action step. Right now, or after this video, go to your investment platform. Find every fund you own and look specifically for 2 terms, expense ratio, or in Europe, total expense ratio, which is abbreviated TER. Every fund has it. Every fund must disclose it. You just have to know to look for it. Now, what should you be looking for in terms of numbers? Here is the benchmark. Anything above 0.5% is expensive. Anything above 1% is very expensive and very hard to justify. The best index funds in the world, Vanguard, Fidelity, iShares, charge between 0.03 and 0.2%. That is a target range. If you are paying more than 0.5%, and right now, in this moment, many of you watching are, I want you to ask yourself one question. Why? What is that higher fee giving you? Better returns? We are going to show you data in a moment that answers that question definitively, and the answer is going to surprise you. Fee type number 2, transaction fees. These are the fees your brokerage charges you every time you buy or sell an investment. Now, here is some genuinely good news. This one has largely been solved. Most major online brokers in the USA, UK, and Australia now offer $0 commission trades. 0. However, and this is important, there are still traps here. Some platforms charge fees for mutual funds while offering free ETF trades. Some charge for options trading. Some charge inactivity fees if you do not trade frequently enough. And some platforms in Europe still charge per order fees. Always check the specific fee schedule of your platform before you start. Fee type number 3, advisor fees. This is often the largest, least discussed, and most misunderstood fee of all. If you pay a financial advisor to manage your money, which many people do, you may be paying between 0.5 and 2% of your total assets every single year. Not one time, every year, forever. Let me make this concrete. A 1% annual advisor fee on a $500,000 portfolio, which is not an unusual portfolio size for someone in their 50s, is $5,000 per year. That is $5,000 leaving your pocket every year, compounding against you over time. But here is the real cost. Over 20 years of compounding, because that $5,000 was also money that could have been invested and growing, a 1% advisor fee on a $500,000 portfolio cost you approximately $180,000 in lost investment returns. $180,000. Now, does this mean you should never use a financial advisor? No. It means you should be very deliberate about how you pay for financial advice. There is a better model. It is called a fee-only fiduciary financial planner. And here's why it changes everything. A fee-only fiduciary planner charges you a flat fee, typically between $1,500 and $3,000, for a comprehensive one-time financial plan. They create your investment strategy. They tell you exactly what to buy, in which accounts, and why. Then you implement it yourself on a low-cost platform. You pay once, then you keep all future returns, every single dollar. Now, I want to address the most common objection I hear when people first learn about low-cost index funds. The objection is this: but surely a skilled professional fund manager can beat the market and justify the higher fee, right? It is a reasonable question, and the data has a very definitive answer. S&P Global publishes an annual report called the SPIVA report that stands for S&P Indices versus Active. And in the 2024 edition, looking at 15 years of performance data, they found the following: 92% of actively managed large cap US funds, 92% underperformed their benchmark index. Think about what that means in practice. 9 out of 10 professional fund managers, with their teams of analysts, with their Bloomberg terminals, with their decades of experience, did worse than simply buying an index fund. And they charged you 1 to 2% more per year for the privilege of that worse performance. I want to say this directly and clearly. This is not a debate in the financial research community anymore. It was a debate in 1990. Decades of data from S&P, from Morningstar, from Vanguard's own founder, John Bogle, who pioneered index funds, all point to the same conclusion. For the vast majority of investors, low-cost index funds win, full stop. So you understand the problem. You understand the 3 fee types. You understand why index funds win. Now the practical question is, where should you actually invest? Because not all platforms are created equal, and your choice of platform is also a fee decision. Here are my recommendations by country. If you are in the USA, you're actually in one of the best environments in the world for low-cost investing. The top recommendations are Fidelity, which offers 0% commissions and has excellent in-house index funds with some of the lowest expense ratios available, Vanguard, which pioneered low-cost investing, and Charles Schwab, another excellent zero-commission option. In the UK, Vanguard UK is the gold standard, straightforward, low cost, and purpose-built for long-term investing. InvestEngine is also worth looking at, with a very competitive 0.25% platform fee and a growing range of ETFs. Both are significantly better than going through a traditional bank's investment arm. Australians have Perler, which is specifically designed for long-term index investors. It even has features to keep you from making emotional decisions. And Stake, which offers access to international markets. Both are dramatically better fee-wise than going through a traditional Big Four bank in Australia. Germany and France, Trade Republic charges just €1 per order, and Scalable Capital is another solid option. For Brazilian investors, XP Investimentos and New Invest, which is part of the Nubank ecosystem, are both significantly better options than going through traditional large banks. The key principle is the same everywhere in the world. Find a platform that gives you access to low-cost index funds with the lowest possible fees on the platform itself. All right, we have covered a lot of ground today, and I want to make sure you walk away from this video with one very specific, very concrete action, not just knowledge, but action, because knowledge that does not lead to action is just entertainment, and this topic is too important for it to be just entertainment. Here is your assignment, and I am calling it an assignment because I want you to actually do it. This week, not someday, not eventually, but this week, do a fee audit on your investments. I'm going to walk you through the exact steps right now. Step 1, open your investment platform or brokerage account. Step 2, find every fund or ETF or managed investment you currently hold. Make a list on paper, in a spreadsheet, anywhere. Write down every single holding. Step 3. For each one, look up the expense ratio or TER. Write that number beside each investment. This might take 15 minutes. Do it anyway. It is worth thousands of dollars of your time. Step 4. Add up your total annual fee cost. Take the expense ratio of each fund, multiply by the amount you have invested in it, and add them all together. Then, and this is the part that will wake you up, multiply that annual fee by 20. That is a rough estimate of what those fees are costing you over a 20-year period in lost compound returns. And then, I want you to share what you find in the comments below this video. I genuinely mean that. When you share your number, it helps every other person watching. It shows them this is real. It shows them the exact impact of fees on real portfolios. You sharing your number could save someone else thousands of dollars. That is worth doing. If this video gave you something valuable, and I believe it did, please share it with one person in your life. Your partner, your sibling, your closest friend. Anyone who is investing right now without knowing their fee. This is not self-promotion. This is genuinely one of the most financially impactful things you can share with someone you care about. Let me close with this. You earned every single dollar that you invested. You worked for it. You chose to save it instead of spend it. You made the smart, disciplined decision to put it into the market instead of leaving it in a savings account. You did everything right. Now make sure you keep as many of those returns as possible. Fee minimization is not boring. I know that is how some people think of it, but it is not boring. It is one of the single highest leverage financial decisions you will ever make in your entire life. More impactful than picking the right stock. More impactful than timing the market. Just quietly, systematically, relentlessly choosing low-cost investments and keeping what you earn. Thank you for watching this one. I will see you in the next video. And until then, go do that fee audit. You will be glad you did.